found a way to start day trading with just $4. And this is exactly what I do if I had to start over from scratch. And the best asset to do this with is called futures. I've built a strategy where I only trade for 60 minutes every morning. And if you have a full-time job, it's perfect for you. I struggled for years to become consistently profitable. But once I focused on this one simple strategy, everything changed for me. And not just for me, but for other traders, I've taught this as well. Years ago, I was risking about $50 per trade, making $100 per trade. And now, years later, I am risking around $1,500 per trade, and I can make over $5,000 on a single trade in just that 60-minute window. So after years of watching the S&P 500 index, I noticed something. In the first 60 minutes, every single morning, the market always has volatility. It pushes hard in one direction and then often reverses the other way. And so what I did is I built a simple 5-step entry checklist to take advantage of that move that happened. This completely changed my trading for the better, because if the setup isn't there, I don't trade. I just move on with my day and try again tomorrow. That one shift alone stopped me from consistently losing money trading. So every morning I mark key reversal zones on the 15-minute chart. Then I drop down and wait for price to come into that area and show signs of a reversal. The confirmation I like to use is looking for patterns like a head and shoulders, a double bottom, and I don't like to use other indicators. I just use price action, trend lines, and support and resistance levels. Over time, I realized I actually don't need anything else. More indicators actually made things more complicated for me, and simpler actually made me more profitable when it comes to trading. Now, once I'm in a trade, I manage my risk, trail my stop, and as price moves in my favor, I exit when the momentum starts to slow down. Now, here's what makes this really powerful. You can start practicing this with almost no money. The platform I've used for over 5 years now is called NinjaTrader. You can start practicing trading using real-time market data for around $4 a month, which is cheaper than most platforms. And I'll leave a link for this in the description if you want to check it out. And when you're ready to switch to real money, futures allows you to start as little as $20 to $50 of risk per trade. That's why I think futures are one of the best ways as a beginner to get started. You can start really small and scale up over time using the exact same strategy. I also don't recommend starting with prop firms as a beginner. Early on, you're gonna make mistakes. That's a part of the process. But with a prop firm, those mistakes get more and more expensive. You're essentially paying over and over to demo trade. It's statistically proven that it's extremely hard for a beginner and just anyone in general to pass a prop firm challenge and actually get access to a real account. It's much better to practice first, then slowly transition into risking small amounts of real money, like $20 per trade, and build that up over time. That way, you can build the mental side of trading gradually. With prop firms, it's often 0 to 100. You're demo trading, and then all of a sudden you're managing a $100,000 account, and you're about to make $8,000 on a trade if it's profitable. And most beginners can't make that switch. It becomes way too intense too fast. That's why I believe a slow, scalable approach is the better path. So let's go over the basics of futures so you can have a clear understanding of how they work. Futures work differently than stocks in many ways, but once you understand them, it's very, very simple. Just like trading a normal stock. That's what drew them to me in the beginning. If you buy it and it goes up, you make money. And if it goes down, you lose money. The first big difference is when you buy one share of, let's say, Apple, you can hold that share as long as you want. You own a piece of that company and it never expires unless the company goes bankrupt. With futures, you aren't actually buying a share of something. You're buying a contract agreement, and the value of that is based on the market it's connected with. So for example, if you buy one futures contract of the oil's market, the contract value goes up if the price in oil increases, and the contract's value goes down if it decreases. The exact same way your share price of Apple would go up and down. So when it comes to trading, there's really no difference there, but the only thing is the futures contracts expire unlike shares. The length of a futures contract depends on the market you're trading, but generally it's 1 or 3 months. This is the one reason why futures are better for short-term trading. It's not something you hold long-term. For you and me, they're really day trading assets. Now, technically, when you buy an oil futures contract, you are buying the ability to buy 1,000 barrels of oil at a certain price. But in reality, you're never doing that. You are just using this contract as leverage, because buying this contract costs a fraction of the price of purchasing 1,000 barrels of oil, but you get the value increase or decrease of those 1,000 barrels of oil. It's the exact same thing as buying a house with a loan. You get the increase or decrease in the value of the house, but you only have to put up a fraction of the cost as a down payment. In the trading world, that down payment on the house is called a margin requirement. Just think of it like collateral you have to put up to get one futures contract of oil. For example, buying one contract of the S&P 500 futures can take $500 worth of margin. Your account will have $500 taken away, but then when you sell the contract back, you get that $500 worth of margin back. Now, this isn't taking into account the profit or loss you made on that trade. So when you see the price of the S&P 500 futures trading at something like 7,000, it doesn't cost you $7,000 to buy one contract. It's based on the margin requirement at the time. Now, the margin requirement differs from market to market and brokerage to brokerage, and what time of day it is. So let's break that down because that's kind of confusing. First off, you have what is called intraday and overnight margin. For example, US stocks are only open during the New York trading session, which is 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. This is the only time you can trade stocks. Futures, on the other hand, are almost open 24 hours a day, 6 days a week. They technically close for a short amount of time after the New York session closes and also over the weekend. But that's how the intraday and overnight margin difference is made. So the requirements for intraday margin are pretty much 22 hours out of the day. Even though it's called intraday, it's technically while the market is trading during the day and trading during the night, you have that lower intraday margin requirement. And then the overnight margin requirement, or another way to say it is maintenance margin, is just for when the market is actually closed. The whole reason for this is the risk is higher because the market closes and it can have news happen while it's closed, and then there can be a huge jump or change in price, which adds risk to a trade. And so that's why the brokerages require higher margin. And so the overnight margin requirements are only from that 4:45 p.m. Eastern Standard Time to 6 p.m. Eastern Standard Time. The market's closed for about an hour, and so you have to have the higher margin requirement just for that hour every day. And so it's closed for the weekend, and so on Friday at 4:45 p.m. Eastern Standard Time, that lower margin requirement will shoot back up to the overnight margin requirement, and then it'll be closed all the way until Sunday at 6 p.m. Eastern Standard Time. This also works for holidays where it's closed, and that'll also have a higher margin requirement. Now, these margin requirements can change based on brokerage. For the intraday margin, some brokerages don't have a lower margin requirement, which can be around $7,000 for one ES futures contract. Others have low margin requirements, and this is where the power of futures really comes into play. It's platforms like NinjaTrader that I use only require $500 worth of margin for one contract of the S&P 500 futures, which is tiny for how much leverage it actually gives you. But for almost all platforms, the overnight margin, which is initial margin or maintenance margin, is never reduced. It's always at that massive size of $7,000. And you can always find these numbers looking at your specific brokerage. But these can also change if the volatility of the market goes crazy. Usually when the market is crashing, like during COVID or any of these last big spikes lower that the market has had since then, that even the intraday margin, like on NinjaTrader, can go from $500 to $1,500. And that's because the volatility in the market is so big that they essentially, the brokerages require more collateral for you to take a trade because the risk is higher. You'll often get an alert from your brokerage to know when this is happening. Now, another minor difference between future contracts is you have ones like oil where you're actually gaining control over a physical object. If you held your contract to expiration and exercised it, it would settle with barrels of oil. You would technically get an email saying this is where you go pick up your 1,000 barrels of oil. Other ones like the indexes, like the S&P 500, they aren't based on a physical object and it's just settled in cash. Now, don't worry, 1,000 barrels isn't really gonna show up at your house or be delivered to you. If you're day trading or even holding them over a couple of days, this will likely never happen. And even if it does, you can always just sell those back without actually doing anything with them. And when it gets to the end of a contract, because they expire, you start trading the new contract. This is called rollover. On NinjaTrader and other platforms, you generally don't have to worry about this as the system will automatically update it or send you a pop-up notification when it's time to do that. And all this means in NinjaTrader is you are changing the ticker symbol, which is technically has the date of the contract in it, to the next one. So for the S&P 500 futures, which expires every 3 months, it's always the same month and third expiration of that month. Pretty much you get one that expires every quarter. So you have one that expires 03, 06, 09, and 12. Those are the months of the year. And then you put the year at the end of it. So if you're looking at the expiration of June 26, the ticker would look like ES626. And that's just saying the month of expiration. Now, I've always found that changing over the Monday of expiration week is the way to go. That's when most people switch over, so the volume changes to the new contract. Also, this way you never have to worry about dealing with 1,000 barrels of oil showing up at your house. And at least for NinjaTrader, it will automatically do this generally when it's time on that Monday. It's not really something you have to worry about, but you want to be aware of it. Now, that $500 worth of margin for one S&P 500 futures contract is still a massive amount for a small account if you're wanting to start trading a small amount and increase your size. So what you can do is you can trade something called the micro futures contracts. All the large futures contracts like the S&P 500, the NASDAQ, oil, gold, they all have one and they're essentially a tenth of the size. So for the S&P 500 futures, it costs $50 worth of margin to get control over one contract, but the value and price movement you gain is also a tenth of the size. It's a super simple way to start small and grow your account. This is how you can risk as little as $20 per trade. I did the exact same thing with my account when I started. I started trading the S&P 500 futures, micro contracts, and I slowly traded more and more. I traded one contract, then I took two, then I had 3 contracts per trade. And over time, I eventually switched to the mini contracts. It's a little confusing with having micro and mini, but the mini are the normal size that I currently trade and what you'll eventually scale up to. Now, the other massive difference between shares and futures is how the movement in price relates to the dollar change of your trade. For shares, it's really simple. They're based on the dollar movement. And so if it goes up 1 penny, you make 1 penny on each share you own. Its value is based on the dollar. Now with futures, it's completely different. First, the price movement isn't based on money. So if you're looking at, let's say the ES futures, one ES contract goes from 7,000 to 7,001, your contract value doesn't go up $1. It actually goes up $50. And this incremental movement of 1 is actually called 1 point. Now going back to shares, the smallest amount they can move is 1 penny, right? Apple can move from $100 to $100 and 1 penny. But this isn't the smallest amount of movement that futures contracts have. The ES futures, the smallest amount they move is 0.25, which is called 1 tick. 1 tick is essentially the smallest amount of movement in any futures contract, and that tick size will essentially change. But for the ES, it's 1/4 of the point, so it's valued at each tick movement is $12.50. And these change from market to market. And so for the ES futures, the smallest tick is 0.25 and it's $50 a point. But for oil, the smallest tick movement is 0.01 and it's valued at $10 a tick. So 1 point of movement in oil is $1,000. But if you look at the two markets, the amount they move is drastically different. Oil moves on a much smaller scale, so the sizing makes sense. It's generally only valued between $60 and $80, when the ES futures are trading at around $7,000 right now. Now, one thing to be aware of trading futures is you are over leveraging yourself. Only putting up $500 worth of margin isn't your max loss on a trade. Technically, you own one contract of the ES futures, and if the market suddenly crashes, you could lose more money than your account. Now, I've never had this happen, and it almost never does happen. There's a few ways to protect yourself from this happening. One is always have a stop loss in place no matter what, and never move it further away, increasing your potential risk once you're in a trade. Because if the market opens and goes against you really quick, this will get you out of the trade as fast as possible, not allowing you to take an overly large loss. And really the only way to have this happen, of stories that I've seen where people do lose more money than their account, is they hold something into the market close. So for example, let's look at a chart right here. This is the S&P 500 futures on a 15-minute. And if you held a contract into the market close right here with a stop loss down here, well, technically when the market opened again, it opened all the way down here, which would completely blow through your stop loss. That's how you lose a larger amount of money. And so because of that, just don't hold through the market close. There's really no reason to do that. Lastly, the only fees that come with trading futures are pretty much commissions and some fees added on by the processing companies that make these trades happen. These will generally differ slightly between futures contracts and also platforms you're trading, but the brokerages are so competitive now, it's pretty much the same across the board. And as well, even though we talked about margin, there's no interest rates or fees with taking out margin, at least for trading futures. So I know this is an insane amount of information and can get really confusing when you first hear it. I want to go into a chart now and show you the practicality of actually doing this and show you that it's really not that complicated. It seems like a lot initially, but when it actually comes to trading, it's pretty simple. I want to quickly show you a trade I took from a little while ago to kind of show you the smaller size version of what we're talking about and the practicality of things. And so basically is, I don't want to get into my strategy too much. I just want to kind of look at the practicality of how they work. And so, I see that the market's coming down to an area that I would like to look for a reversal trade off of. And so all I do is on NinjaTrader, you're able to click on the chart to put in a buy stop order. And so I put in a buy stop order right here for 3 contracts. And I'm saying, okay, if the price hits here again, I want to enter in on a trade. And so it enters in. You can see this is the price, the dollar movement going up and down. And so you can move your stop loss right here just on the screen. And so I had it essentially below this kind of bottom we put in. And then from there, you can kind of see the dollar value go up and down. And it's a smaller amount of money than what I normally trade right now. But this is the practicality and the scaling part of it, which is really, really good. Now, this is still pretty decent size. You can go way smaller than this if you're trading the S&P 500 and trading, 1 contract versus 3. And so just to kind of zoom this through is kind of once it kind of gets going here is I move my stop loss up to something like break even here. And then I start to, you can see I break up my trade into multiple orders and I scaled out here once it kind of got up to a nice amount of profit that I liked. You can see here it goes from 3 contracts to 1 contract because I closed out for a profit on a couple of those. And then from there, so this is how you could see just what 1 contract would be is you could trade these swings and get $100 or $200 per contract on a swing like this. And this is how I don't scalp when it comes to futures. Some people look for really small moves. I still look for swing trades on a daily chart. To me, it's a little bit easier to become profitable doing that. And to me, my strategy has worked really well for that. And you can see over here on the left side, the NASDAQ also has 1 tick. The smallest size it moves is 0.25. It's happening pretty quick. The NASDAQ, you can see, is valued much higher than the S&P 500 futures. The NASDAQ at this time is around 19,000. And I think during this time, the ES was valued at around 5,000. Now in current market, it's much higher, but it's the same thing. And you can see here that it moves up and down based on 0.25 increments. You know, it can jump a little bit because the price is moving so quickly. And so that's how it works out. And, you know, easily you can, I find it just super practical to trade. Now to get started practicing everything, make sure you get NinjaTrader. I'll leave a link for it in the description below. Now, if you want a video that goes into my strategy more, check out this video right here. It goes into my 5-step entry checklist in detail. And make sure you come watch me live stream my trading on YouTube every morning at 9:15 Eastern Standard Time.